Enron began as a conventional energy company and then tried to reinvent itself as something far bigger, a new economy marketplace where energy to be traded like financial products. To investors and many in the public, the company looked modern, fast, and brilliantly engineered. Its leaders promoted a story of creativity, turning pipelines and power plants into a high-tech trading and deal-making machine. As the stock price climbed, Enron became a symbol of ambition. Inside that success story, several forces were quietly building. First was intense performance pressure. Enron's culture celebrated boldness and constant growth. Meeting expectations was not just a business goal, it was treated like a measure of personal worth. Teams were encouraged to bring in deals and show results quickly. When a company rewards speed and big headlines, people can start to treat caution and skepticism as obstacles rather than safeguards. Second was complexity. Enron expanded beyond simple energy delivery into trading, risk products, broadband ideas, and global projects. Complexity can be a normal part of business, but it also creates hiding places. When financial statements become hard to interpret, the average reader, sometimes even experienced professionals, may struggle to see the true picture. Complexity can be used responsibly, or it can become a curtain that makes weak performance look stronger than it is. Third was the gap between cash reality and reported success. In many businesses, large projects take time to become profitable. Enron wanted the market to see growth immediately, even when the cash from projects was uncertain or far in the future. That mismatch between long-term risk and short-term reporting creates a temptation. Make tomorrow's hoped-for gains look like today's confirmed results. A key idea that enters the story here is how performance is measured and presented. Enron promoted itself as a leader in financial innovation, and some of its reporting choices helped it present smoother earnings, reduced visible debt, and a steady image of momentum. The details involved complicated structures and accounting judgments. Importantly, for viewers trying to learn from this case, the lesson is not about copying techniques. It is about recognizing warning signs, statements that become unusually hard to read, profits that rise even when the business environment is shaky, and reporting that emphasizes cleverness over clarity. Many people around Enron also had incentives to keep the success story alive. A soaring stock price benefited executives, employees with stock-based compensation, and outside partners who profited from deals. Media praise and industry awards reinforced the idea that Enron was special. When a narrative becomes powerful enough, It can shape what questions feel acceptable to ask. Skeptics may be labeled negative. Supporters may become emotionally invested in the company's image. At this stage, Enron's public face was confidence. The educational takeaway is that major corporate failures often do not begin with one dramatic moment. They begin with small compromises under pressure, choosing the most optimistic interpretation, delaying bad news, and rewarding people who make the numbers work. When incentives, complexity, and storytelling combine, a company can appear strong while becoming fragile underneath. Enron's early rise set the conditions for what came next, a system where maintaining the appearance of growth became more important than honestly describing uncertainty. And once a company crosses that line, each reporting period can feel like a new test, one that pushes leaders to take even bigger steps to protect the illusion. To understand why Enron's reporting later became a major scandal, it helps to focus on a simple educational concept. Financial statements are not only math, they also reflect choices. Companies make judgments about value, risk, timing, and classification. If those judgments are consistently optimistic, the reported picture can drift away from economic reality. One of Enron's central challenges was volatility. Trading businesses can experience large swings. If a company promises smooth growth while operating in a volatile environment, tension appears. The question becomes, how do you keep the story of steady success when the underlying business is uneven? Enron increasingly leaned on structures and accounting approaches that made results look more predictable and debt less visible. A major feature in the Enron story is the use of special purpose entities, separate legal structures used in many industries for legitimate reasons, such as isolating risk or financing specific projects. These structures become problematic when they are used primarily to move obligations out of sight, reduce apparent leverage, or create transactions that look like independent deals but are not truly independent. In an educational framing, the warning sign is not the existence of such entities alone, but how they are used, whether the company retains the risk while claiming it has transferred it, and whether the arrangements are designed more for appearances than for genuine business purpose. Another theme is valuation. Some business lines involve estimating future value, especially when assets are hard to sell quickly or markets are not deep. Estimation can be reasonable when supported by evidence and transparency. It becomes dangerous when assumptions are repeatedly pushed toward best case outcomes, while worst-case scenarios are hidden or minimized. Over time, optimistic valuation can create paper profits that do not match cash inflows. In many accounts of Enron, the company's deal-making culture also mattered. Deals were celebrated, and internal recognition often focused on closing transactions rather than on long-term performance. When the act of signing a deal is rewarded more than the outcome of the deal, reporting can begin to treat future hopes as present achievements. This is where oversight should step in. Boards of directors, risk managers, internal audit, external auditors, analysts, and regulators all play roles in protecting the accuracy of public reporting. Yet, Enron's environment made oversight unusually difficult. Complexity reduced transparency. Rapid growth created constant change. Strong leadership narratives discouraged pushback. When oversight bodies rely heavily on the company's own explanations and models, the line between verification and trust can blur. A helpful educational lens is to look for structural red flags rather than focusing only on personalities. Red flags include earnings that rise steadily while cash flow looks weak or erratic, frequent complex transactions with limited clear business purpose, disclosures that are technically present but hard for normal readers to understand, a culture where questioning is treated as disloyalty, heavy reliance on short-term market perceptions to support long-term commitments. By the time Enron's methods were deeply embedded, it likely felt internally like a machine that could not stop. Each quarter's reporting built on past assumptions. If earlier optimism was never corrected, admitting the truth later would cause a sharp reversal. That fear can lead to a cycle. To avoid one painful correction, leaders take steps that make the eventual correction even larger. The educational point is clear. Scandals often grow from systems. When incentives reward appearance and complexity reduces accountability, the financial picture can drift far from reality without a single moment where someone says, "Now we will do something wrong." It can feel instead like a series of choices made to manage expectations until the gap becomes too large to hide. Enron's story is not only about accounting, it is also about organizational behavior. Many large failures occur when a workplace becomes a results theater, where people learn that what matters most is the performance of success, not the substance of success. A frequently discussed element of Enron's culture was intense internal competition. Employees were evaluated aggressively, and there was strong pressure to stand out. In such environments, short-term wins can dominate. People who bring impressive numbers may be promoted quickly, while those who raise concerns may be seen as slowing progress. Even without harsh words, the message can become obvious. Stay aligned with the success narrative if you want to thrive. In a healthy organization, skepticism is a form of care. In a fragile organization, skepticism is treated like disloyalty. Over time, employees may self-censor. They may avoid asking questions in meetings. They may frame concerns as minor or keep them private. Silence is not always consent. Sometimes it is survival. This leads to a key educational insight. Wrongdoing does not require everyone to participate. It only requires enough people to look away, assume someone else is checking, or believe that the system is too complex for them to challenge. When tasks are specialized, individuals may focus on their narrow roles. Someone might see one troubling piece, but not the whole pattern. If no one connects the dots, the organization can continue moving forward even as the risk grows. Another part of the human system is incentive design. When compensation is tied strongly to stock price and deal volume, people may unconsciously prioritize market perception. This does not mean every person is acting with bad intent. It means the structure nudges behavior. Over time, incentives shape what feels reasonable. A choice that would once have seemed risky can start to feel normal because everyone around you is making similar choices and the external praise keeps arriving. Leadership communication also matters. When leaders repeatedly describe the company as exceptional and unstoppable, employees may internalize that identity. If the company is the future, then critics must be out of touch. If the company is changing the world, then setbacks are treated as temporary obstacles rather than signals of deeper issues. A powerful story can make uncomfortable facts easier to ignore. Whistleblowing is often discussed in corporate scandals because it reveals how difficult it is to speak up. Reporting concerns can be emotionally and professionally costly. People worry about being labeled problematic, losing opportunities, or being excluded from key projects. Even if formal policies say speak up, informal culture can say the opposite. From an educational standpoint, the Enron case encourages listeners to ask what protections make truth-telling possible. Strong internal controls help, but so do cultural practices. Leaders who reward honest questions, boards that demand clarity, and audit committees that insist on understandable explanations. Transparency is not only a technical standard, it is a social standard. As Enron's internal system matured, the gap between the company's public image and its underlying stability widened. When that gap grows, The organization becomes dependent on confidence. Confidence becomes an asset that must be defended. And once a company becomes dependent on confidence, it may take increasingly elaborate steps to preserve that confidence, because a loss of trust can trigger rapid collapse. In this phase of the story, we see a subtle but crucial shift. Enron was no longer simply trying to build a great company, it was trying to maintain an image of greatness. The educational lesson is that cultures built on fear of failure can turn into cultures that hide reality until reality forces itself into view. Every large corporate collapse has a period where the public story begins to crack. For Enron, that period involved growing scrutiny from analysts, journalists, and market observers who started asking why the company's numbers were so hard to reconcile with simpler indicators of business health. A common early signal in such cases is confusion. Confusion might sound mild, but it matters. When professional observers repeatedly say, "We don't fully understand how this company makes money," that is not a neutral statement. It is a warning that transparency has weakened. In strong companies, complexity can exist, but the core business logic remains explainable. When a company cannot explain itself plainly, trust becomes fragile. As questions increase, a company has a choice: simplify, clarify, and correct, or defend, distract, and intensify complexity. Defensiveness can temporarily protect the stock price, but it also raises the stakes. If a company responds to questions with more complicated explanations rather than clearer ones, skeptics may become more determined and supportive observers may become uneasy. Another factor is market psychology. Financial markets are highly sensitive to confidence. For companies that rely on trading relationships, credit, and counterparties, trust is not just an image issue, it is operational. If partners worry that a company's financial position is uncertain, they may reduce exposure, demand more collateral, or refuse new deals. That can create a self-reinforcing cycle. Concern leads to tighter terms, which increases stress, which creates more concern. As Enron's situation moved toward crisis, the company faced the challenge of liquidity, having enough available cash and credit to meet obligations as they came due. Even if a company has valuable assets on paper, it may still face trouble if it cannot access cash quickly. When trust erodes, raising cash becomes harder. Investors hesitate. Lenders tighten. Partners step back. In educational documentaries, it is important to describe this phase without sensationalism. The key point is structural. Once trust declines in a highly interconnected financial business, the timeline can speed up. What looked manageable in a calm market can become urgent in a worried market. During the unraveling, internal decision-making becomes more stressful. Leaders must decide what to disclose, how to communicate uncertainty, and whether to revise prior claims. The longer optimistic reporting has continued, the harder it becomes to reverse course. Correcting the record may cause immediate damage, but refusing to correct it can cause even larger damage later. Meanwhile, governance mechanisms are tested. Boards must evaluate conflicts of interest, risk exposures, and the integrity of financial reporting. Auditors must decide whether they have sufficient evidence for the statements. If controls have been weak, these institutions may find themselves reacting rather than leading. A painful element of such collapses is that ordinary employees and retirees can be harmed even if they had no role in decision making. When a company's identity is tied to its stock and long-term promises, a sudden decline can affect savings and careers. This is why corporate ethics is not abstract. It touches real lives through pensions, jobs, and community stability. As Enron's story moved toward a breaking point, the market's patience thinned. The questions were no longer academic, they were existential. What is the company actually worth? What risks are hidden? Can the company survive if partners demand stronger guarantees? This stage is a reminder for viewers. Corporate scandals are often preceded by clear signals: complexity without clarity, confidence without transparency, and success narratives that resist simple verification. When those signals appear, the safest response is not panic, but careful skepticism. Ask for cash flow clarity, risk disclosure, and plain language explanations. Enron's collapse became one of the most discussed corporate failures in modern U.S. business history. The company moved from admired innovator to a case study in governance failure, reporting problems, and incentive-driven decision-making. In this phase, events accelerated. As trust declined, the company's ability to operate normally weakened. Confidence is often treated as a soft factor, but for a company deeply involved in trading and finance-like activities, confidence functions like infrastructure. Without it, everyday transactions become harder, more expensive, or impossible. When collapse arrives, the public often searches for a single cause, a single villain, a single document, a single moment. Educationally, it is more accurate to see the collapse as the end of a long chain. The chain includes pressure to meet expectations, complex structures that reduced clarity, valuation choices that favored optimism, and a culture that rewarded deal-making over long-term performance. Investigations and legal proceedings that followed focused on accountability and on whether statements and practices met required standards. These proceedings also influenced public debate about how corporate reporting should work and what responsibilities auditors, boards, and executives carry. One major consequence was a shift in how people talked about corporate oversight. The Enron case contributed to the sense that trust alone was not enough, that internal controls and independent checks needed to be stronger and more transparent. In the aftermath, regulators and professional bodies emphasized stronger governance practices and greater accountability in financial reporting and auditing. For the public, the human impact mattered. Employees, many of whom were proud of their work, faced uncertainty and loss. Communities connected to the company experienced shock, not in a sensational sense, but in the quiet disruption of jobs, savings, and plans. This is an important educational point. Corporate reporting is not a private language for specialists. It is a social contract that protects everyday people who rely on truthful information. Another consequence was reputational. The scandal became a reference point for future discussions of too good to be true corporate stories. Investors learned to pay more attention to disclosures, to question complexity, and to treat consistent, unusually smooth performance with careful skepticism, especially when cash flows do not match reported earnings. From a risk management perspective, the case also highlighted the importance of conflict of interest controls. When individuals or teams can benefit personally from structures that the company uses for reporting or financing, oversight must become strict and transparent. Without those safeguards, even talented people can end up making decisions that favor short-term appearance over long-term integrity. Enron's collapse also changed how companies think about culture. Tone at the top became more than a slogan. Leaders shape what employees believe is rewarded. If leaders reward honesty and clarity, people will bring up problems sooner. If leaders reward only outcomes and punish doubt, people will hide problems until they become unmanageable. In documentary terms, it's helpful to end this section with a calm but firm lesson. The cost of weak integrity is not only legal or financial, it is the erosion of trust in institutions. Markets depend on credibility. When credibility breaks, the damage spreads widely, far beyond the people who made the original decisions. Enron's story, therefore, is not simply about a company that failed. It is about how systems, financial, organizational, and cultural, can drift away from reality when transparency is treated as optional. And once that drift becomes large enough, collapse is not mysterious. It is the natural outcome of a structure built on fragile confidence. The Enron scandal remains a powerful educational case because it offers practical lessons for investors, employees, leaders, and students of business. The goal is not to memorize details, but to recognize patterns that help prevent future harm. First, learn to separate complexity from clarity. A business can be complex and still transparent. If you cannot understand how value is created in plain language, treat that as a risk signal. Look for financial reporting that explains the core drivers, where cash comes from, what risks exist, and what assumptions are being used. If the explanation relies mainly on technical language without clear summaries, skepticism is reasonable. Second, compare earnings to cash flow over time. In many situations, cash flow is harder to smooth than reported profit. If reported success is rising while cash flow appears weak, inconsistent, or heavily dependent on financing, ask why. This is not proof of wrongdoing, but it is a reason to investigate deeper. Third, watch incentives. When leadership compensation is closely tied to stock price and short-term targets, the organization may become vulnerable to appearance management. Strong governance can balance this by rewarding long-term performance, risk control, and transparent reporting. Fourth, respect the importance of internal controls and independent oversight. In healthy companies, the board and audit committee demand understandable reporting. External auditors maintain independence and professional skepticism. Internal audit is empowered. Risk managers are listened to. If you ever see a culture where oversight is treated as a formality, that is a serious warning sign. Fifth, create real pathways for speaking up. Whistleblowing systems only work when people believe they will be protected and heard. Organizations should make it normal to raise concerns without fear of retaliation or social punishment. Leaders can model this by thanking people who point out uncomfortable issues and acting on those signals early. Sixth, be cautious with too perfect stories. Markets and businesses are naturally uneven. When a company presents itself as consistently exceptional while operating in a volatile environment, ask what stabilizes the results. If the answer is financial innovation, ask for transparent evidence rather than slogans. Seventh, understand that ethical risk is also business risk. Ethical shortcuts may look like solutions under pressure, but they usually multiply future costs. The most resilient organizations build systems that make honesty easier than deception. Simple reporting, clear incentives, strong controls, and cultures that reward truth more than applause. Finally, for everyday viewers, the Enron case encourages a balanced mindset, neither cynicism nor blind trust. The best approach is informed skepticism, asking for clarity, looking for consistency between words and cash reality, and valuing transparency as a sign of strength. Enron's story became famous because the gap between image and reality grew too wide. Educationally, the most valuable takeaway is that such gaps are detectable early if people are trained to look for them and if institutions insist on plain truth. When organizations choose clarity, humility, and strong oversight, they reduce the risk of repeating this pattern. And when individuals choose integrity under pressure, they protect not only themselves, but also the wider community that depends on trustworthy information.